In this TaxLayer Pro webinar, we'll go over tax relief for disasters for the 2018 tax year. Prior to the Tax Cuts and Jobs Act, you could claim itemized deductions for personal casualty losses that weren't compensated by insurance, including losses from storms, theft, fire, or other incidences. Now, for tax years 2018 through 2025, the personal casualty and theft loss deduction is only available in the cases of natural disaster and only for taxpayers with property in a federally declared disaster area. This presentation is an overview of the types of relief that may be available as a result of a federally declared disaster. Congress may pass legislation specific to a particular disaster that may differ from these general rules. This presentation will discuss matters that relate to individual taxpayers. Now, while we touch on a few issues related to businesses, our main focus will be on disaster-related relief provisions for individuals. Keep in mind that the rules related to casualty losses for businesses did not change as a result of the Tax Cuts and Jobs Act, while the rules for individuals did. And again, the Tax Cuts and Jobs Act provided that for taxable years beginning in 2018 through 2025, any personal casualty loss shall be allowed as a deduction only to the extent that it was attributable to a federally declared disaster. Now, the objectives of this presentation: we're going to identify types of relief that are available to taxpayers in a disaster area. We'll go over how to calculate disaster area casualty losses. We'll document disaster area casualty losses. And we'll discuss obtaining information about federally declared disaster areas. We'll also learn about the IRS disaster assistance and emergency relief programs. Now, we don't presume to make you an expert on these topics. We simply want to raise your awareness of these topics so that you can better help your tax return clients. Now, as far as the types of disaster relief, there are a number of different types of relief that are available to victims of federal disasters: administrative relief, tax relief, the safe harbor provisions, and the election to claim disaster losses on a prior year tax return. Each of these provisions offers a different type of relief. In addition, each provision has its own qualifying criteria, and that can make determining whether they apply to a taxpayer in a particular situation a bit challenging. Now, we'll walk through each of these provisions so that you'll become a little more familiar with each type of relief. Now, some of the key points of each. There are two different types of relief for disaster victims: administrative relief and tax relief. Administrative relief means granting additional time to file tax returns, such as 1040s, to pay taxes, like estimated taxes, and to perform other time-sensitive tasks, like contributing to a qualified retirement plan. Tax relief means claiming casualty losses on tax returns. The type of FEMA designation, whether public or individual, determines the type of relief, whether administrative, tax, or both, that are available to disaster victims. Now, just what is a disaster area? Well, it's any area determined by the President of the United States that warrants assistance by the federal government under the Robert T. Stafford Disaster Relief and Emergency Assistance Act. And how would you find out if a weather-related event is designated a federally declared disaster area? Well, these areas will be posted to the FEMA website at www.fema.gov, and some are posted to the IRS website at irs.gov. Now, here are the different types of administrative relief that can be made available for federally declared disasters. Administrative relief is granted by the IRS in geographic locations designated by the President as federally declared disaster areas and when FEMA designates an area to receive individual assistance. When this happens, special tax law provisions may help affected taxpayers recover financially from the impact of a disaster. The IRS may grant additional time to file tax returns, grant additional time to pay taxes, grant additional time to perform certain other time-sensitive acts, and waive or abate interest and late filing or late payment penalties. These relief stipulations give the taxpayer a little more time to deal with the crisis at hand. When you're the victim of a natural disaster, you're concentrating on the more important things like, where am I going to live? How am I going to eat? Do I still have a job? Not, am I going to be able to file my tax return on time? The IRS issues a press release outlining what forms qualify for delayed filing, what taxes qualify for delayed payment, and how much additional time will be granted to file tax returns and make payments. Another type of administrative relief offered by the IRS to federally declared disaster victims is the waiving of fees for obtaining copies of tax returns and expedited requests for the copies of tax returns. Copies of actual tax returns can cost $50 and take weeks to obtain. Those $50 fees are waived and the requests are expedited. In order to get fees waived, clients will need to write the applicable disaster title information, including the disaster number, in red at the top of Form 4506, which is the request for a copy of a tax return, or Form 4506T, which is the request for a transcript of a tax return. Both forms are available at irs.gov. Copies of tax returns can also be obtained at an IRS Tax Assistance Center. They can be requested by phone, by mail, or through a tax preparer who is qualified to use the transcript delivery service through IRS e-services. The IRS maintains a list of the zip codes that are located in federally declared disaster areas, so only the 4506 and 4506T forms with those zip codes can have the fees waived. And now at this point, let's take a quick look at a review question. What are the different types of administrative relief? Granting additional time to file tax returns, granting additional time to pay taxes, granting additional time to perform certain time-sensitive acts, waiving or abating interest and late filing or late payment penalties, or E, all of the above. Well, if you guessed all of the above, you got it. So now we've talked about administrative relief, types of administrative relief. Who are the affected taxpayers? Well, any individual whose principal residence is located in a disaster area, the spouse of an affected taxpayer, solely with regard to a joint return of a primary taxpayer and spouse, or any business entity or sole proprietor whose principal place of business is located in a disaster area. In addition, any individual, business entity, or sole proprietorship not located in a covered disaster area, but whose records necessary to meet an IRS deadline are located in the disaster area. The point is, you don't have to live in a federally declared disaster area to be an affected taxpayer. If you or your spouse live in a federally declared disaster area, assuming you file a joint return, or if you're a taxpayer who's not located in the disaster area but whose records are, you can qualify as an affected taxpayer. And this applies only to the postponement up to 1 year of certain tax-related deadlines by reasons of a federally declared disaster. Being an affected taxpayer means that the individual can qualify for any of the administrative relief provisions that we previously talked about, like granting additional time to file tax returns, paying certain types of taxes, and perform certain time-sensitive tasks. Now let's hit another quick review question. True or false? You do not have to live in the affected area to be considered an affected taxpayer. For example, the taxpayer's records are stored in the disaster area. That is a true statement. You don't have to live in the affected area to be considered an affected taxpayer. And now FEMA assistance. When the President declares a federal disaster, FEMA determines which counties or parishes make up the disaster area. FEMA also determines what type of assistance to offer in the disaster area. FEMA assistance can come in one of three forms: public assistance, individual assistance, or a combination of the two. Public assistance provides grants to state and local governments for items such as debris removal, repairing roads and bridges, public buildings, and public utilities. Individual assistance provides grants for items such as temporary housing, housing repair and replacement, as well as funeral expenses. Now this slide explains what types of assistance FEMA provides and how the different types of assistance have tax implications for individual taxpayers. The type of assistance designated by FEMA dictates the type of relief that's offered by the IRS. If the FEMA designates an area to receive public assistance only, that area will not usually qualify for administrative relief. So areas granted public assistance will not be granted additional time to file tax returns, pay taxes, or perform other time-sensitive acts. So the IRS grants administrative relief only when a designated area gets FEMA individual or public and individual assistance. When FEMA grants individual assistance or individual and public assistance, the IRS will put out a press release outlining the specific types of administrative relief being granted. These press releases are available on the IRS website. Any type of FEMA assistance enables taxpayers in a disaster area to claim the qualified casualty losses on their tax returns. Again, that bears repeating. Any type of FEMA assistance enables taxpayers in a disaster area to claim the qualified casualty losses on their tax returns. Now next is an example of a FEMA disaster map. The map is coded in 3 colors. Each color represents different FEMA disaster declaration specifications. The counties in white would not receive any type of administrative disaster relief. However, the taxpayers who live in the counties colored in white might be able to deduct casualty losses on their tax returns if the losses are considered attributable to a federally declared disaster. The yellow or gold areas on the map are designated by FEMA to receive public assistance only. These taxpayers would qualify for claiming losses on a tax return. However, they wouldn't qualify for administrative relief, for example, additional time to file returns or additional time to pay taxes. The brown areas on the map qualify to receive individual and public assistance and would qualify for both administrative and tax relief. So these taxpayers would be able to claim casualty losses on their tax returns and also be allowed additional time to file returns and pay certain taxes. So, to recap, a taxpayer does not have to be in a federally declared disaster area in order to claim a casualty loss. However, and this is a big however, the casualty must be attributable to a federally declared disaster and be located in the state where the disaster has been declared. Remember, these rules apply to individual taxpayers. Business taxpayers are subject to a separate set of rules. Now let's run through another review question. When is administrative relief usually granted? When FEMA designates an area to receive individual assistance? When FEMA designates an area to receive individual and public assistance? Or when FEMA designates an area to receive public assistance only, or both A and B? And if you said both A and B, when FEMA designates an area to receive individual assistance, or when FEMA designates an area to receive individual and public assistance, you got it right. Now just a reminder, All notices that the IRS posts when granting disaster relief are on the IRS website. So, type the word disaster in the search field and follow the links to see what types of relief are being granted for each county in your state of interest. So now, in the previous slides, we've mentioned casualty losses. Let's take a look at the definition of a casualty. A casualty is considered, for IRS purposes, the damage, destruction, or loss of property resulting from an identifiable event that is sudden, unexpected, and unusual. The term sudden means swift, not gradual or progressive. The term unexpected means ordinarily unanticipated or unintended. And the term unusual means not a day-to-day occurrence and not typical of the activity in which you are engaged. The terms sudden, unexpected, and unusual are used to describe the characteristics of a casualty and were established in various revenue rulings and court cases. Recently, casualties have occurred in disaster areas that have suffered hurricanes, wildfires, tornadoes, and floods. These weather-related events have been determined to be sudden, unexpected, and unusual, and therefore the damage and loss of property because of them meets the definition of a casualty. So, how does a taxpayer compute the casualty loss? Well, a casualty loss is considered to be the lesser of a decrease in fair market value, or FMV, as a result of the casualty and the adjusted basis before the casualty. You subtract any insurance or any other reimbursement received from the smaller of 1 or 2 above. Now, a couple of things to remember when it comes to loss reimbursements. If in the year of the casualty there is a claim for reimbursement and there's a reasonable chance of recovery, then no portion of the loss that may be reimbursed is allowed. You must reduce your loss even if you don't receive the payment until a later tax year. If your property is covered by insurance, you must file a timely insurance claim for reimbursement of your loss. Otherwise, you can't deduct any reimbursed portion of the casualty. The portion of the loss not covered by insurance, for example the deductible, is not subject to this rule. Now, there's two methods to determine the decrease in fair market value that are outlined in the Treasury regulations. The first method is by competent appraisal. This appraisal must recognize the effects of any general market decline affecting undamaged as well as damaged property, which may occur simultaneously with the casualty, in order that any deduction under the Treasury regulations will be applied to the actual loss resulting from damage to the property. The second method is cost of repairs. The cost of repairs to the damaged property is acceptable as evidence of the loss of value. The repairs are necessary to restore the property to its condition immediately before the casualty, and the other stipulation, the amount spent for such repairs, is not excessive. Using either method is acceptable for determining the decrease in the fair market value of the property. When using either method, the loss is limited to the adjusted basis in the property. Now, there's some additional limitations to deducting casualty losses on your tax return. First, you have to itemize your deductions. If you don't itemize, you generally can't deduct casualty losses on your tax return. Assuming you do itemize your deductions, your casualty losses would have to be larger than $100 and would have to exceed 10% of your adjusted gross income in order to derive any tax benefit for claiming the loss. Now, losses of personal use property are calculated on Section A of Form 4684. And again, just to recap, there's a $100 per loss limit, and the loss would have to exceed 10% of the adjusted gross income in order to derive tax benefit. And disaster-related casualty losses are deductible only if the taxpayer itemizes deductions on the return. The claim for a casualty loss has to be attributable to a federally declared disaster. Again, this is new for 2018 tax returns. The taxpayer must have suffered a casualty loss. The taxpayer must itemize on the return. The casualty loss must be larger than $100 and must exceed 10% of the individual's adjusted gross income. And again, all these qualifiers must be met for an individual to claim a casualty loss on the tax return. All these qualifiers do not apply to business casualty losses. All the business has to do is suffer a qualifying casualty. The business does not have to be in a federally declared disaster area. In addition, a business casualty loss would not be deducted as an itemized deduction or be subject to the $100 and 10% adjusted gross income rules. Now here's an example of how to deduct a casualty loss. In this example, in 2018, a hurricane has destroyed a home in Florida. The president declared that a major disaster exists in the state of Florida due to the hurricane. The home costs $144,800 when first purchased. This is the only casualty loss for the year. The fair market value of the home immediately before the disaster was $180,000. Now, unfortunately, the fair market value after the disaster was $35,000, which is basically the value of the land. So, the loss is $144,800, which is the lesser of the adjusted basis of the property or the decrease in the fair market value, which is $145,000. This loss is before you start accounting for your insurance reimbursement. Now we start with the $144,800 loss, which is the lesser of the fair market value or the adjusted basis of the home. The insurance company pays $130,000, which goes to reduce the loss. Then the loss is further reduced by $100 and 10% of the adjusted gross income for the year, which was $80,000. This means that the deductible casualty loss is $6,700, which is deducted as an itemized deduction on the tax return. Now, the go-to publication for examples like this is Publication 547, Casualties, Disasters, and Thefts. If you claim a casualty loss, you must adjust your basis in the property. And to do so, decrease basis in the property by any insurance or other reimbursement and any deductible loss. You increase the basis in the property by any amount spent on repairs that prolong the life of the property, increase its value, or adapt the property to different uses. To make this determination, you compare the repaired property to the property before the casualty. Next, we'll look at a few safe harbor provisions. Now, what exactly is a safe harbor provision? Well, it's an exception to a general rule. With these safe harbor provisions, you don't have to use the normal methods for determining decrease in the fair market value discussed in the previous slides. Rather, you can use one of these provisions to determine the decrease in the fair market value. The safe harbor provisions on this slide refer only to personal use residential real property. These safe harbor provisions do not apply to business casualty losses, and the different safe harbor methods for determining the decrease in fair market value for personal use residential real property are the estimated repair cost method, the de minimis method, the insurance method, the contractor safe harbor, and the disaster loan appraisal. So, just what do these safe harbor methods do for the taxpayer? Well, let's go back to the computing a casualty loss slide to explain. Remember, we said that a casualty loss is the lesser of the decrease in fair market value as a result of the casualty or the adjusted basis before the casualty. Safe harbors are an alternative method for computing the decrease in fair market value as a result of the casualty. This is one of the factors in computing a casualty loss. It's the first factor on this slide highlighted in red. Now, the estimated repair cost safe harbor method allows you to compute the decrease in the fair market value of your personal use residential real property using the lesser of two repair estimates prepared by separate and independent licensed repair contractors. And again, just to reiterate, the estimated repair cost method goes like this. Use the lesser of two repair estimates, and the estimates must detail the itemized costs to restore the property to its condition immediately before the casualty. And this estimated repair cost method is limited to casualty losses of $20,000 or less. And keep in mind, these safe harbor methods are for personal use residential real property only. Next, the de minimis method. The de minimis safe harbor allows you to figure the decrease in the fair market value of your personal use residential real property based on a written good faith estimate of the cost of repairs required to restore your property to its original condition immediately before the casualty. You must document how you estimated the amount of your loss. This safe harbor method is only available for casualty losses of $5,000 or less. Next up, the insurance safe harbor method. The insurance safe harbor method allows you to figure the decrease in the fair market value of your personal use residential real property based on the estimated loss in reports prepared by your homeowners or flood insurance company. And these reports must set forth the estimated loss you sustained from the damage to or the destruction of your property. Next, the contractor safe harbor. Now, this doesn't apply unless you have a binding contract and you use the contract price for the repairs specified in a contract prepared by an independent and licensed contractor to determine the decrease in the fair market value of your property. This also requires a binding contract signed by the taxpayer and the contractor setting forth the itemized costs to restore the property. Again, for personal use residential real property only. The disaster loan appraisal method, and just like all the other safe harbor methods, this method can only be used for personal use residential real property, and the property must be located in a federally declared disaster area. This safe harbor requires an appraisal prepared to obtain a loan of federal funds or a loan guarantee from the federal government that identifies your estimated loss. Now, this next slide still discusses safe harbor, but we've added a little twist. These safe harbors are for personal belongings. Now, under the de minimis method, you must provide a good faith estimate of the decrease in the fair market value of your personal belongings. And this method is limited to losses of $5,000 or less. You must maintain records describing your affected personal belongings as well as your methodology for estimating your loss. To use the replacement cost safe harbor method, you must first determine the current cost to replace your personal belongings with new ones. Then reduce that amount by 10% for each year that you owned the personal belonging. And you can view a personal belonging valuation table in Revenue Procedure 2018-08. And if you choose to use the replacement cost safe harbor method, then you must use that method for all of your personal belongings. The safe harbors are available for personal belongings that are located in a federally declared disaster area. Now let's look at a few disaster-related payments that are not included in a taxpayer's gross income. And these qualified disaster relief payments are not included in gross income to the extent that any expense that was compensated by such payment is not otherwise compensated for by insurance. So if a taxpayer receives a disaster relief payment and doesn't receive any insurance or other reimbursement for qualified expenses, the relief payment is not included in gross income. Now, there are three types of disaster relief payments, and qualified disaster relief payments are also payments to reimburse or pay reasonable and necessary personal, family, living, or funeral expenses incurred as a result of a qualified disaster. For example, a taxpayer's family home is completely destroyed by a tornado, and the family receives funds which don't include insurance proceeds to put them up temporarily in a hotel. Then those payments would not be included in income. Now, the second type of disaster relief payments are payments incurred for the repair or rehabilitation of a personal residence, or repair or replacement of its contents to the extent that the need for such repair, rehabilitation, or replacement is attributable to a qualified disaster. Assuming a taxpayer does not receive any insurance or other reimbursement for the expenses, the payments would be excluded from gross income. For example, if the taxpayer did not have flood insurance for the home but received funds to help replace drywall in a damaged home, then those funds would be excluded from gross income. And finally, qualified disaster relief payments are grants paid by a federal, state, or local government or agency in connection with a qualified disaster in order to promote the general welfare. These payments are based upon need and are excluded from gross income. Now, two other items not shown are payments made by charitable organizations or employers, and these payments may also be excluded from gross income. Now, there's no double benefit related to qualified disaster relief payments that are allowed. And this means you can't have a deduction or a credit that would be allowed to the extent of the disaster relief payments that are excluded from income. Excluding disaster relief payments from income applies only to individuals. These exclusions from income do not apply to businesses and their casualty losses. Now we'll discuss disaster mitigation payments. Relief payments and mitigation payments may sound like the same thing, but they're different. Qualified disaster mitigation payments are any amount paid pursuant to the Robert T. Stafford Disaster Relief Act or the National Flood Insurance Act to or for the benefit of the owner of any property for hazard mitigation. Let's look at a few examples to see what these are and how to treat them on a tax return. Now, qualified disaster mitigation payments are made by FEMA to taxpayers under the FEMA Disaster Mitigation Program. FEMA defines mitigation as the effort to reduce loss of life and property by lessening the impact of disasters. These programs include the Flood Mitigation Assistance Program, which provides funding to protect life and property from repetitive future natural disasters. The Hazard Mitigation Grant Program provides post-disaster funding, again, to protect life and property from future natural disasters. And these are payments that individual property owners receive from FEMA to reduce the risk of future damage to their property. Qualified disaster mitigation payments are excluded from gross income. In addition, qualified disaster mitigation payments do not increase the basis of property. No deduction or credit is allowed related to qualified disaster mitigation payment. However, just like qualified disaster relief payments, no double benefit related to the disaster mitigation payments is allowed. Now, on this slide, we'll discuss the tax treatment of gains on unscheduled personal property. No gain is recognized on any insurance proceeds received for unscheduled personal property that was part of the contents of a main home. An unscheduled property insurance payment is a lump sum insurance reimbursement received for the contents of a home or apartment that was involved in a disaster. Usually, an insurance company will list in the policy what types of property must be scheduled, such as high-value jewelry or high-end computer systems, but other household items are classified as unscheduled. This income exclusion applies for homeowners and renters who receive insurance proceeds from damaged or destroyed property in a home or apartment as a result of a federally declared disaster. So, taxpayers who receive insurance payments or reimbursements for unscheduled property, then no gain is recognized on that property. Some examples of unscheduled property would include clothes, bedding, small electronics, sports equipment, and jewelry of minimal value. So let's say the insurance company gives you $100 for a TV that might have been worth $75. Then no gain is recognized on that television. That's what this provision means. Now, payments for temporary living expenses received by an insured individual directly from FEMA are also excludable from gross income. And that's the key. The living expenses have to be directly from FEMA. Now, your clients may be coming to you, the tax professional, to determine if they need to claim any 2018 related disaster losses on their 2018 or their 2017 tax returns. Now, this provision only applies in cases where there is a federally declared disaster and the loss occurred in the disaster area and was attributable to the federally declared disaster. Any type of assistance designated by FEMA would qualify the taxpayer to make the election to deduct the casualty loss in a prior year. Doesn't matter if the assistance is public or individual. The taxpayer would qualify to make the election to deduct the casualty loss in the prior year. Now remember, this election is only available for casualty losses attributable to and located in a federally declared disaster area. Now, to make this election, the taxpayer must include a Section 165I election statement containing the following information. Include a statement either on the original return or the amended return with the following: the disaster name or description, the date or dates of the disaster, the city or town, county, state, and zip in which the damaged or destroyed property was located. You'll also need to include the FEMA declaration number, which can be found on the FEMA website. The election to claim disaster losses on a preceding year tax return can be made up to 6 months after the due date of the taxpayer's federal income tax return for the disaster year, without regard to any extension of time to file. And this is effective for tax returns filed after October 13th, 2016. For example, if a casualty loss occurred in 2018, the taxpayer has the option to claim the disaster loss on either the 2018 or the 2017 tax return. If the taxpayer elects to claim the 2018 casualty loss on the 2017 tax return, then they'd have to file a 1040-X or amended return on or before October 16th, 2019. Now let's look at another review question. If a taxpayer suffers a qualifying casualty loss attributable to a federally declared disaster in 2018, can the taxpayer amend the 2017 tax return if it results in a larger tax benefit? Yes or no? Well, the answer is yes. The taxpayer can amend the 2017 return if it results in a larger tax benefit. Now let's talk about documenting casualty losses. How do you do it? Well, this slide illustrates some of the general information needed to document a casualty loss in a federally declared disaster area. Document the type of casualty, whether it's a car accident, fire, storm, so on, and when it occurred. The loss was a direct result of the casualty in a federal disaster area, and you were the owner of the property, or if a lessee, you were contractually liable for the damage. Now here's some examples. For real estate or residential real property, even where some of the records may have been lost to the disaster. Take photographs as quickly as possible to establish the extent of the damage. Contact the title company or bank that handled the purchase for copies of escrow papers. Make a video of the inside and outside of your home with your cell phone. If you know that a hurricane is coming in your direction, don't put yourself in danger, but this may be a good time to make a video of your home while walking around your house before the disaster strikes. Use your current property tax statement for land versus building ratios, and if that's not available, contact the county assessor's office. You can also document a casualty loss by using an appraiser. The fair market value of the property both before and after the disaster can be documented by an appraiser. Contact contractors or builders for records related to the property. Some additional ways to document the value of property include checking with the county assessor's office for old records about the property. Get a copy of the deed for the property. For inherited property, check court records for probate values. For personal property, make a diagram or floor plan of the property and include where furniture was placed. It doesn't have to be perfect, just a rough sketch of the floor plan. Also, include any bookcases where pictures were located and shelves, including personal items, were located. Reconstruct from the original cost invoices or old sales catalogs to document your personal property. The fair market value can be determined through local thrift stores, local newspapers, and the library. And again, make a video of the contents of your home with your cell phone. A video is one of the best and simplest ways of documenting what you have in your house. Videos before and after a disaster are an excellent way of documenting your losses, not only for your tax return, but for any insurance claims. Disaster damage does not always result in a casualty loss. On rare occasions, disaster-related casualties do result in a gain. Gains on casualties occur when taxpayers receive insurance payments or other reimbursements that are in excess of the adjusted basis of the property that was damaged or destroyed in a disaster. The formula for computing a gain on a casualty is the insurance or other proceeds that were received less the adjusted basis of the asset equals the gain from the casualty. So, a gain is possible if the insurance or other reimbursement is greater than the adjusted basis of the property, and in some cases, the gain may be postponed under what's called the involuntary conversion provision of the Internal Revenue Code. Gains on casualties are rare, but they do exist. As far as reporting casualty gains and losses, if a taxpayer receives an insurance reimbursement after deducting a casualty loss, and if the reimbursement is less than expected, you would include the loss on the tax return for the year in which the taxpayer can reasonably expect that no more money will be received as insurance reimbursement. And if a taxpayer receives more of an insurance reimbursement than they expected after they've already claimed the deduction for the casualty loss, then they may have to include the extra reimbursement as income in the year they received it. However, if any part of the original deduction did not reduce their tax for the earlier year, do not include that part of the reimbursement as income, and also do not refigure the tax for the year the deduction was claimed. Again, insurance reimbursement after deducting a loss, if greater than expected and accounted for as a casualty loss, include the difference as income in the year it was received. IRS Publication 525 has more detail. Next, net operating losses. If a taxpayer has more deductions than income for the year, he or she may have a net operating loss, or NOL. An allowable deduction for a personal casualty loss can generate or increase a taxpayer's net operating loss for the year. Individual or business casualty losses, again, can generate net operating losses. The portion of an NOL that's generated by casualty losses cannot be carried back, but can be carried forward indefinitely. And the exception to carrying back this NOL belongs to farmers. A list of the federally declared disaster areas by state and county are provided at the FEMA website, fema.gov/disasters. Information on IRS-designated disaster areas can be found at irs.gov/disaster relief. The FEMA website contains a wealth of information on disasters. A list of federally declared disasters by state and county are provided on the FEMA website. FEMA declares a level of relief for every federally declared disaster. Remember that individual assistance or public assistance affects the tax relief that individual taxpayers are entitled to. The IRS website gives information on the administrative assistance to taxpayers. Now, after certain disasters, the IRS may provide staffing at major recovery centers. The IRS may provide staffing at major centers to hand out disaster publications, provide information on casualty loss determinations, assist with questions on tax laws and procedures, assist with record reconstruction, and assist in obtaining copies of tax returns. Now, some resources that the IRS offers to victims of disasters as well as tax professionals who deal with tax-related disasters are IRS Publication 547, Casualties, Disasters, and Thefts, Pub 584, Casualty, Disaster, and Theft Loss Workbook, Publication 2194, Disaster Resource Guide, and the 2194 has a handy chart to help compute casualty losses, and the Form 4684, Casualties and Thefts, which accompanies the 1040. Other resources include a disaster hotline number, Revenue Procedure 2018-8 and IRC Section 165I, and Revenue Procedure 2016-53. We want to thank you for watching this TaxSlayer Pro webinar on casualty and theft losses for 2018.